Welcome to The Critique. Today we're looking at Ford Motor Company. Its history is really a study in industrial control, ambition, and the constant push and pull between corporate strategy and its social consequences.
And in this critique, we're examining this American icon by exploring the real-world trade-offs in their decisions, but we're deliberately steering clear of any moral judgment.
So let's jump right in. We can start with what is probably the most enduring tension in Ford's history.
The relationship between management and its labor force.
Exactly. The core idea here is that the company has this century-long struggle for absolute control over its workers. It's all rooted in the basic principles of Fordism.
And this struggle for control created these deep, recurring costs that really all culminated in the 2023 UAW negotiations.
You see this control laid out so clearly in the early days. I mean, Henry Ford's famous $5 day. It wasn't just about pay.
I know, it was leverage.
Complete leverage. The sociological department had inspectors going into workers' homes, checking on cleanliness, marital status, how they spent their money.
And if you failed a second inspection, you were just fired.
Right. And then the analysis kind of leaps forward to the 2023 United Auto Workers stand-up strike.
Yeah, where the company lost an estimated, $1.7 billion in profits before it finally conceded these historic gains to the union.
Including the cost of living allowance, or COLA, coming back.
Okay, so I think the biggest opportunity to strengthen this whole analysis is right there in that gap.
The gap between the 1920s and 2023.
Exactly. You've got these two incredibly high-stakes moments, the early crackdown and the huge 2023 union victory. But the jump between them is just too wide. It makes it feel like a simple ahistorical tension, and we miss showing a continuous institutional struggle.
I see the structural weakness you're pointing to, but doesn't the sheer scale of the 2023 win kind of imply that long-term tension? Why do we need to drill down into a specific failure in the middle?
Because we need to show how that Fordist control didn't just fail in 2023. It was suffering from decades of, let's call it, institutional decay. The failures compounded.
Okay.
The goal here is to analyze the ultimate cost of that sustained resistance from labor. So if we can show that the 2023 concessions were just the inevitable reversal of these temporary corporate wins from leaner years, well, the argument becomes so much stronger.
So what you're saying is the analysis needs a mechanism. It needs to show how corporate control failed in between those 2 points, to prove that control wasn't static. It was more like a debt that was just accumulating interest over time.
Precisely. A really powerful way to do that is to pick one key concession that the company won during a time of economic stress, something that directly set up the demands we saw in 2023.
And that would demonstrate that labor always saw these losses as temporary, as recoverable.
Yes, not a permanent change.
Okay, let's focus on the tiered wage system. The material already mentions that the 2023 strike demanded an end to concessions, just like that one.
Good. So to make the consequence really land, we should highlight the specific moment that system was introduced, around 2007, 2009, right?
Right. During the automotive industry crisis, there was immense financial pressure, the shadow of government bailouts.
And management's argument was what?
Survival. They successfully argued that this tiered structure, paying new workers a lot less for the exact same job, was essential for the company to survive. It was a huge, hard-won victory for them, strategically.
That's the mechanism we need to expose.
It let them lower their long-term labor costs.
Exactly. And by framing the 2023 elimination of that system, where you see temp worker pay jump by up to 145%, as the reversal of that painful corporate victory, we completely transform the 2023 streak.
It's not just another negotiation anymore.
No, it becomes the final, incredibly costly reckoning for management's attempt to divide the workforce.
It's the cost of the illusion of control. And, you can see the same dynamic with the reinstatement of COLA, the cost of living allowance.
How so?
Well, management got rid of COLA years ago. They saw it as a permanent win, a permanent reduction in their economic risk. But then what happens?
Inflation spikes.
And suddenly that historical concession becomes the single most expensive line item in the new contract.
So every short-term victory for corporate control just set the stage for a bigger, more expensive fight down the road.
Right, that gives us a much stronger cause and effect narrative. It moves the whole labor dynamic from a simple back-and-forth struggle to a kind of dialectic of historical debt.
And that gives the whole opening section a new weight. Okay, let's shift gears. Let's move from the cost of labor control to the mechanism that preserves dynastic control, the dual-class stock structure.
This is fascinating. The idea that the corporate structure, which was designed to ensure family stability, simultaneously created a way to insulate leadership from real shareholder accountability.
Right. The material lays it out. The dual-class system gives Ford family shares 36 votes per share,
compared to just one vote for a regular shareholder. So that super voting power obviously reduces management's accountability.
It does. And the analysis points to a really compelling democratic deficit here. Since 2011, a shareholder proposal for one vote per share has consistently gotten over 51% of the independent non-family vote.
And yet management has done, quote, absolutely nothing to address it.
The material also brings up the rejection of management pay back in 2021, almost 500 million votes against.
And family directors still got nearly 200 million negative votes each, but their positions are totally secure because of that stock structure.
Right, but I think the analysis stops a bit short here. It describes the structure and the shareholder frustration, but it treats it purely as a governance issue.
Okay.
To really fit the neutral, consequentialist tone of this critique, we have to analyze the industrial trade-off. Is this insulation protecting a long-term vision, or is it just protecting incompetence?
That's a crucial pivot. We need to go beyond just describing the voting mechanism and actually examine the industrial cost of that protection.
Yes.
If the CEO is protected by 36-to-1 voting power, then they're structurally shielded from the consequences of very expensive mistakes.
Exactly. The way to elevate this section is to use that insulation to analyze its impact on strategic risk management, on performance tolerance.
So we should link the structural protection directly to, say, major write-offs that in a normal company would probably result in a change in management.
Absolutely. And we know Ford has had massive write-offs during its EV pivot. Billions invested, billions written off. If leadership is insulated, they can tolerate a level of strategic error that a normal public company, beholden to shareholder reaction, could never survive.
It's a buffer zone, basically. So we could connect the shareholder opposition to the pay packages, those hundreds of millions of negative votes, with the operational reality.
Think of it this way. That $1.7 billion cost of the UAW strike was a huge operational failure. It was a miscalculation.
Sure.
Now, if that cost had happened under a one-share, one-vote system, the management team would be facing a crisis of confidence, big enough to force changes at the top.
But here, the dual-class structure acts like a protective bubble.
It buffers the executives from the immediate financial consequences of their own decisions. It allows them to absorb a blow like that strike cost, which is really just a payoff of that historical labor debt we talked about, without their jobs being on the line.
So it's not just about voting rights, it's about the cost of dynastic security.
And that forces the really interesting question. If the system protects management from necessary short-term pain, does it prevent the organizational rigor you need to navigate massive changes?
Like the one we're about to discuss.
Exactly.
That reframes the section perfectly. It turns a description of corporate governance into an analysis of strategic resilience, or maybe the lack of it. Okay, let's look at the third dynamic, the electric vehicle pivot.
And this is where it all comes together. The material frames this massive investment in the EV transition as this strategic commitment to the future, a shift toward what some people call post-Fordism.
And post-Fordism here means what?
Technological integration, putting more value on R&D and brand.
The smile curve, where the value moves away from pure manufacturing and toward high-end things like design and marketing.
Right, and Ford sees this. They're making enormous capital commitments, $1.2 billion in Louisville, $1 billion in Kansas City, adding new battery capacity. Okay, what I like here is the clear contrast. You have this huge commitment to the future set against the immediate, painful costs.
The present is punishing. The UAW strike costs $1.7 billion, and then Ford pauses construction of its $3.5 billion EV battery factory in Marshall.
Which drew that very public criticism from the UAW president.
Right. But I think the analysis, as it stands, treats this EV pivot as a standalone challenge. It sort of separates it from the control dynamics we were just talking about.
Precisely. The goal should be to use the EV pivot not as a third topic, but as the intersection point for all the tensions we've already introduced. It's the ultimate test.
That makes the whole critique much more holistic. So, the shift to a post-Fordist model needs decentralized decisions, flexibility, innovation.
But
It's being governed by a structurally insulated leadership because of the dual-class stock, and it depends on a highly centralized and now newly combative workforce from the UAW.
we have to make that connection explicit. Instead of just listing the investments, we should contrast the nature of the work needed for the EV future with the historical model.
The original Fordist model was Taylorism, centralized control, forcing rigid habits on the workforce to optimize the assembly line.
And the EV pivot needs the exact opposite. It needs flexible specialization, higher value labor, technological integration. That requires a partnership with labor, not coercion.
So the core tension is that the organization was built on coercive control, and now it's facing a massive technological shift that demands flexibility. But all the old control mechanisms are fighting against it.
And the Marshall battery plant pause is the perfect example of that.
It wasn't just a financial decision. It created that public spat with the UAW because it showed the political limits of Ford's investment calculus.
Right. They paused their big commitment to the future at the exact moment the workforce was demanding job security for that same future.
And that matters because Ford had to grant those job security concessions to keep EV production under the UAW contract for the F-150 and Transit EVs in Kansas City. The union used the pivot as leverage.
It shows that the company can't get to its high-value post-Fordist future without first resolving this century-old resistance in its labor structure.
All while the management is shielded from the urgency of that problem by its own stock structure. It's the ultimate bottleneck, created by a century of centralized control.
That brings a powerful, unified sense of consequence to the whole critique. We've looked at 3 decisive dynamics that are all converging right now on the company's balance sheet.
Okay, so to recap the most significant areas for improvement, we focused on 3 actionable steps to strengthen the analysis. First, in the labor section, we have to bridge that chasm between the 1920s and 2023. We do that by tracing the legacy of concessions, like the tiered wages from 2007, and showing how that directly set up the very costly 2023 reckoning.
Right, turning the labor dynamic into an institutional, historical debt. Second, we deepen the analysis of the dual-class stock. We moved it beyond just shareholder politics to evaluate its industrial cost.
Its tendency to insulate management from accountability for huge strategic write-offs and operational failures, like that $1.7 billion strike cost. And third, we used the EV pivot as a synthesis point. We showed how the immense investment required for the future is being constrained by the tensions from the past.
The old structure is fighting the necessary future flexibility.
Which makes for a much more robust analysis of the organization's limits. And the fundamental tension? It persists. Can an organization built on centralized control really navigate an era that demands flexible, decentralized decision-making?
Exactly. And does the protection from the dual-class stock structure ultimately shield the company from necessary short-term pain? Or does it just insulate incompetence when faced with these massive strategic trade-offs?
And finally, how will the enormous upfront costs and write-offs of this EV pivot truly reshape Ford's relationship with its workforce and its investors? Especially now that we know the century-old price of labor control has just been added to the bill. These are the questions that offer the clearest path forward.
This is The Critique, where we examine the consequences and limits of American icons.
Explore more case studies at WhyItTV.